Most financial advisors will pat you on the back for maxing out your 401k every single year until you retire. They'll tell you it's discipline. They'll tell you it's smart. As a fiduciary financial advisor with over 25 years of experience, I'm telling you it might be a six-figure tax mistake. There's a mathematical point where your pre-tax 401k becomes too big. And once you cross this line, every dollar you contribute isn't building wealth. It's building a future tax problem with RMDs, your Medicare premiums going up, and Social Security taxation. Today, I'm going to show you exactly how to calculate your stop number, the exact moment you should stop feeding your 401k pre tax, and where you should put that money instead. So let's talk about part one, the tax deferred trap. We're trained to love this tax deduction. You put in 30,000 in your 401k, you save 8,000 in taxes today. It feels like free money. But remember, the IRS has not forgiven you your tax debt. They're just deferring it. Think of your 401k like a partnership with the government. You own part of the account and the IRS owns part of the account. But here's the problem. The IRS gets to decide what their percentage is later when you withdraw the money. By stuffing every spare dollar into this one bucket, you're letting your silent partner grow too powerful. Here's the scenario I see constantly. A couple works hard, they save $2 or $3 million in their 401ks. They retire at 65 and live on cash. Then at age 73 or 75 hits, RMDs kick in. Suddenly, the government forces you to take out 120 or 150,000 a year, whether you need it or not. This income is fully taxable. It pushes you possibly into higher tax brackets and triggers what's called IRMA surcharges on your Medicare, sometimes doubling your premiums. It also makes 85% of your Social Security taxable. You aren't rich, you're just tax inefficient. You've overfilled this bucket. So the big question is, when do you stop? You stop when your current balance, without adding another penny, is projected to grow large enough to fund your lifestyle and fill your standard deduction limits in retirement. So let's do the math. If you're 50 years old and have 500,000 in your 401k and you plan to retire at 65, even if you never contribute another dollar at a conservative 7% growth, that money will double in roughly 10 years. By 65, that 500,000 could easily be 1.3 to 1.5 million just on its own. If 1.5 million generates enough RMDs to fill your lower tax bracket, then adding more money today is just pushing income into higher brackets tomorrow. You've reached coast status in your 401k and the tank is full. So let's talk about the pivot. Where does the money go instead? You don't stop saving, you just stop deferring. You change your buckets. So, strategy number one is the Roth 401k. If your plan allows it, switch contributions to the Roth. You pay the taxes now, but that growth is tax free forever. You're locking in today's tax rates, which, by the way, are historically low right now, and eventually probably will expire and rates will eventually go up. Strategy number two is the taxable brokerage account. This is your freedom fund. Unlike your 401k, there's no penalties if you need the money before age 59 and a half. There are ways to get money out of a 401k from age 55 to 59 and a half without penalty. But if this money is in a pre-tax IRA, you cannot touch that money until you're 59 and a half without a penalty. Also, a taxable investment account gets favorable capital gains tax treatment, often 0 or 15%, which is much lower than income tax rates. If you want to retire early, you're going to need money in this bucket. Now, there's also a third option. If you've hit your coast number, maybe you don't need to save that extra 23,000 at all. Maybe you can use it to build your made life today. The made life framework is something that I talk about in my book, Momentous Decisions. It's an acronym that stands for meaning, accomplishment, difference, and experiences. Maybe that money goes to experiences today. Take the trip while your knees are still good. Or maybe it goes to making more of a difference. Help your kids with a down payment now when they actually need it, rather than leaving them an inheritance when they're 60. Financial planning isn't just about dying with the biggest number. It's about using your resources when they have the most impact. Don't sleepwalk into this tax bomb. Check your balances, run the projections. If you've already won the game in your 401k bucket, Stop playing there. Start winning in the Roth bucket or the taxable investment account brokerage bucket or the life bucket. Start enjoying some of the things you want to do right now. If you'd like help calculating your exact stop number and what strategies you should implement instead, schedule a discovery Zoom with me by clicking the link in the description of this podcast. I'll find out what's important to you and help you develop a plan to live the richer retirement you'd like to, but also maybe enjoying more of your life right now. Time is something that you can't get back. I'm a big fan of living for today. You obviously want to plan for the future, but if you're already on track to fill that 401k bucket with millions of dollars, there's different strategies you need to implement to make sure that you have tax diversification in retirement and enjoy your life while you're planning for retirement. Life enjoyment is not just meant to be postponed for someday when you can retire one day. It's about enjoying a richer life today as well. And if you'd like to pick up my book, Momentous Decisions, 7 Steps to Better Health, More Wealth, and a Richer Life, there'll also be a link in the description of this episode. Would love if you ordered a copy. It's everything I've learned about health, wealth, and life, all in one book, designed to help you live a richer life now and in the future. This is Brian, the Wealth Decisions Guy. Thanks for listening, and I hope to see you next week.